Some may argue that history belongs in the past. We believe it provides a foundation for our future. It informs our wealth of expertise and shows our long-term commitment to ESG. This is not just a trend that we follow.
Good morning and welcome to Bloomberg's The Future of Sustainable Investing, a decisive year for ESG. My name is Alistair Marsh. I'm a reporter covering ESG topics for Bloomberg News, and I'm joining you virtually this morning. Today we're going to discuss whether 2021 will be a decisive year for climate finance. Will we see the financial services sector formalize climate commitments and play its role in helping the world achieve the goal of the Paris Climate Accord to limit temperature rises to 1.5 degrees? We're also later on in the morning going to be delving into fixed income markets and ask why fixed income has been slower historically to embrace ESG compared with equities. We'll discuss the different approaches taken when it comes to sustainable fixed income investing, as well as the impact of new regulation. Before we begin, I'd like to, on behalf of Bloomberg, acknowledge our sponsor, Amundi. Also, if you'd like more information on this topic from Amundi, please go to the Resources tab. Now I'd like to turn to welcome our community from across Europe, the Middle East, Africa, and Asia, and say hello to the thousands of listeners tuning in on social media and via the Bloomberg terminal. A few other items from me, if I may, before we begin. Please make sure you're using Firefox or Chrome for the broadcast. Refresh your browser if you're having any issues with sound. You can restore windows using the buttons at the bottom of your screen, and the size of each window is adjustable. You can also join the conversation via social media, and we would encourage you to follow us on LinkedIn, Twitter, and Facebook using the handles at Bloomberg Live or @Business. Okay, splendid. So let me start then by moving to our first panel and introducing our speakers. We have Cynthia Cummins joining us this morning. She is Director of Private Sector Climate Mitigation at WRI and also a steering committee member at the Science Based Targets. Also joining us is Steve Wagood, Chief Responsible Investment Officer at Aviva Investors. And I'm delighted also to introduce Eric Usher, who is Head of the UN Environment Programme Finance Initiative. Thank you all very much for joining today. We actually have a really good topic of conversation. COP26, the big UN climate change conference scheduled for later this year in Glasgow, is a moment in which governments will make big commitments. We should expect some big news, hopefully, on various NDC announcements from some of the countries around emissions reductions. But actually, uniquely, this is an event in which climate finance will have a real prominent role. And we want to discuss today, I want to discuss with you, does COP26 represent essentially the last opportunity to put markets on a trajectory towards delivering the Paris Agreement? We have, and if my almost schoolboy understanding of climate science is correct, we have very limited time in which to kind of get on with the climate action. We have many banks and investors, I guess we'll talk about this in a moment, who've been committing recently to net zero by 2050. But to get there by 2050 means that we have to cut emissions in half by 2030. That's only 9 years away. That would suggest that urgency is the order of the day. And thus, perhaps COP26 is this last moment, bringing together of an alignment of the stars, so to speak. Now, I'm sure all of you would have opinions on this, and I'd love to hear them all. I'm going to stop talking. And Steve, I'd like to ask you maybe if you would start us off. Do you think COP26 represents the sort of a last chance saloon for getting markets on course to be aligned with Paris?
I'm tempted to just say yes and leave it there, definitely. As you said, the reduction in emissions that we need to deliver to hit net zero by 2050 is huge. It's even bigger than was delivered last year because of COVID. So, yes. And we know that the alignment of the G7 and the G20, the two hosts of that, with the COP26, first time we've ever had the three events aligned like this. Germany in '98 was close, but that was just finance track. So geopolitically, next year, G7 is what? Germany, G20 Indonesia, the COPs in Rwanda. We don't have the same alignment. So on climate finance, honestly, it's the Gs that do more to harness markets than the UN. You don't manage markets by... Even the Paris Agreement is not correcting the market failure. You manage markets by changing fiscal rules, by changing market mechanisms, standards and regulations. So yeah, I think this is the last chance to actually harness the 400 trillion that's out there. Sorry to be so blunt, but that's my honest view.
Blunt is good. Cynthia, maybe I could ask you to be equally as blunt.
I think COP is a critical moment, and this is a really important opportunity to get companies, get the financial sector to make to signal their intention to aim for net zero, which is a really critical North Star, but there is so much more work that has to be done with the financial sector to really define what net zero means, to set interim targets, which are even more critical than these net zero long-term targets, and really understand what the metrics and strategies are that we need the financial sector to take that will drive on the ground emission reductions in the real economy. The financial sector is a few decades behind companies in terms of measuring their impact on the climate and taking action to reduce their impact on the climate and setting targets. So we still have a lot of work to do.
Mm-hmm. Eric, perhaps I could come to you with sort of your UN hat on, of course. What's your view?
Yeah, I mean, I think, this still all is centered on how do we implement the Paris Agreement. And I think Steve is right that, you have 195 governments that sign an agreement. That doesn't get the job done. That provides a framework. And then the question is, what are the impulses, both political, regulatory, and directly from the private sector to move in the right direction? Because a lot of it is, we're doing this for commercial reasons that as a financier, a lender or an investor, we see our clients in a state of change, whether it's in the agriculture industry and infrastructure, in buildings and construction, energy, transport. All of these industries are in the course of change. Anybody who questions that, you look at the value of Tesla versus all other auto manufacturers today. You're seeing the same thing happen in all industries. So I think the really important inflection point we need in Glasgow is we have to drop the notion that everybody needs to be doing something to essentially everybody needs to be doing everything. So it's not about, issuing a green bond or, doing something and then trumpeting about it within your CSR report. It's about your entire business. It's a strategic implication. What does it mean for how we operate, for how our customers operate, who our customers are going to be looking forward? So I would say this shift out of Glasgow, we're seeing leadership going in, leaders, investors, banks, others who are saying we're going to align with net zero, for instance. But the coming out of Glasgow, what we need is the commercial expectation and realization that this is about everything we do. It's not just an add-on.
That's a very interesting framing, because we have had, even in the last just month or two, I mean, if you just look at sort of the net zero announcements and then the trillions of dollars of financing commitments to green energy and renewable and so on, all of that suggests that there is a lot of momentum. There is a lot of, you could say that the pace has really accelerated from where it was. There is a lot of momentum. There is a lot of commitment from the finance sector. But from what you're saying is, I guess, one, maybe it's not enough. And two, it needs to be all encompassing. Maybe talk a bit about how, Eric, if you could continue the thought, how we get to kind of, you mentioned it being about everything. How do we get to that place? Because I think we're a long way from that at the moment.
Yeah, I mean, obviously within an organization, it starts from, strategy, which means governance, which means, is the board discussing these issues? Who's responsible for this within the organization? And then in terms of implementation, it's no longer about having, a great green team. Environmental experts or sustainability experts in renewables. It's how do you deep integrate this, penetrate this across the organization, so everybody is understanding what are the risks in terms of the clients they're dealing with, in terms of the financing. Who are you financing going forward? Can you be predictive on how a changing climate is going to impact the industries you're dealing with? And in terms of how you transact, increasingly being able to track things like low carbon or greening through an organization. So if we take green mortgages for supporting the financing of low carbon housing, if you want to actually finance a portfolio of green mortgages, millions of mortgages, and then securitize them and pass them off into the green bond markets, the number of people within your organization who are able to actually do that, it's not a couple, it's not a handful. It's a very large part of the organization who needs to actually upskill to figure out how do we make this transition. So really, it's about how do we change within the organization. And I think there's the challenge. It has to be credible. It has to, as Cynthia said, it's not about setting targets that our children will have to worry about. It's about what are you doing in 2025 and 2030. You can use it based on the 2050 target, but really it's what does it mean you're doing today?
Interesting. I mean, Steve, I guess you in a way are at the coalface of this, working for a large investor like Aviva. You made some interesting comments earlier on there about the idea of regulation and how in some ways this needs to be pushed. Do you think that the kind of the greening of everything, or the whatever the right slogan we should put on this, but basically all parts of the business embracing the transition and the kind of emissions reductions required for the Paris goals, do you think that that should be mandated, or that businesses like an Aviva or many of your peers can be left to their own devices, or should be left to their own devices on this?
Yeah, I'd like to think of us being more at the kind of solar face than the coal face. So when you said that, I could hear you pause. But I kind of, yes, loads of financial institutions in their marketing material now claim to have ESG in their DNA. And we all know, don't we, that in a large number of cases, it's a relatively recent acquisition, rather than it being actually embedded in their memorandum, their articles, their proper governance, and so on. So can we rely on voluntarism? No, we definitely can't. Voluntary has got us some way, but that's the leaders taking action, as they always do. We need the laggards, we need everybody, and that requires mandating. But then the question is, what do you mandate? Because you can't legally require everyone to become net zero. That's not how markets work. For as long as there is money to be made by doing the wrong thing, someone somewhere will do the wrong thing. And at the moment, the markets are clearly aligned with 3.5 degrees. That's what the implied temperature change of our stock exchange, for example, is suggesting in terms of what's being capitalized. So markets are not aligned. So you can't mandate UK pensions to become net zero because the real economy isn't. So we have to correct the market failure, and you do that by making the polluter pay, in the kind of euphemism, or internalizing the externality, if you want to get a bit jargonistic about it. And there are ways that people are doing that, and it is definitely possible to require financial institutions to mandate them to produce a target to be net zero. When will you deliver net zero on a comply or explain basis? But I don't think you can do more than that. And at the moment, it isn't yet clear whether people are doing that. Oh, Eric wants to come in. Eric, did you want to? Yeah, Eric, I'll pass to you.
Yeah, I partially agree with you, Steve, and I also partially challenge you, because I think it's a bit of a dance between the public sector and the regulators in the private sector. And I would take climate disclosure as an example. The TCFD, the Task Force for Climate-Related Financial Disclosures, it's been quite successful in terms of getting wide uptake. So basically, there's an expectation in the market that you do need to start disclosing. The reality is the depth of the disclosures the quality is not there yet. But we are getting regulators coming in and starting to say, okay, this has been voluntarily led. We start to see uptake. Now we're going to start to look, and maybe we'll start to ratchet a little bit and get more, improve the quality of disclosures, standardize the methodology and the like. I think if it had been started by regulators from the beginning, the uptake would have been much more frustrated, because I think the problem is regulators, they need someone to define the floor of how you do it. And the private sector is the one that understands their business best, and are best based to say, this is how we think we should do it. At the end of the day, regulators don't have to listen to them entirely, but they can learn from them. And I think it's this relationship which is very important to actually sort of the dance to ratchet up together.
Definitely agree with you. Can I come back on that, Alistair? Is that okay?
Please, go on.
Thank you. So, Eric, you almost make my point for me. So, disclosure is something you can mandate. And that's what I'm saying. You can mandate disclosure. I don't think you can mandate, while the real economy is rewarding 3.5 degrees, you can't then go to the investors and say you must be 1.5 as a government unless you give the regulatory framework for the rest of the real economy to deliver 1.5. So I agree with you. There is a dance. And I think the bit of the dance where people are stepping on each other's feet is at the moment you've got, well, the financial institutions are being invited to the dance, and many of them are not even showing up. And most of them that do any stewardship, it's only about the companies. It's only about micro stewardship, engaging with companies at their AGMs and so on. It's not engaging with the system, and it's the system that's flawed. It's a massive market failure. You can't engage with a company and say, don't make profit in a way that's profitable. You have to change the market structure. All systems need to change, and they need to change today. And that's Rachel Kite saying that. A brilliant woman, done amazing things. So yes, it's a dance, but at the moment, people aren't showing up, and they're certainly not helping each other, and neither's leading. Back to you, Alistair.
Great. Well, it's interesting that you bring up the idea of market failure, because we have had some audience questions. And one of the questions was, given repeated episodes of market failure through history, will we be able to act in time to avoid the catastrophic consequences of climate change, i.e. going way above 1.5, maybe achieving the 3.5 that you've been talking about? But Steve, perhaps it sounds like you're already saying we've already failed. We've already had a market failure. It's not there's going to be one. We already are at one. Is that what
it's
you're saying?
the world's biggest market failure. Yeah, well, yes. I'm not just alone in saying that. Nick Stern has said climate change is the biggest market failure of all time. I mean, it could erode a third of the stock of manageable assets, business as usual, by the end of the century. That's, as I put it when I was explaining it to my 10-year-old, she said, "Does that mean money is destroying money, Daddy?" And she's right. That is what it means. It really is as simple as that. Right. So it is a market failure today. It doesn't mean we can't correct it. That a market failure is just the uncorrected economy leads to a suboptimal outcome for society. It's the job of governments to correct market failure, and they've got a huge number of tools to do that: tax, subsidy, monetary policy, market mechanisms, regulations, directives, standards, consumer awareness. We need to throw everything at this. We need to do everything now. As Eric said, I completely agree.
Okay. Cynthia, maybe I could bring you back in here, because, of course, you've been instrumental in the Science-Based Targets Initiative, which is, as I understand it, voluntary, but a way of kind of getting a handle on companies' progress towards net zero and so on. Perhaps you could come in and share sort of your thoughts here a little bit on the idea of, one, on market failure, and two, on sort of forced regulation.
So I can speak at it from my perspective of decades of working on voluntary programs with the private sector and seeing how companies, once they get used to a practice and it becomes common practice, then regulations become much more feasible or palatable, or there's less resistance to them. And now, even with science-based targets, where 5 years ago it was kind of an outlandish idea to think that all companies would be setting science-based targets. It was so ambitious. And now we have 20% of market cap is represented with a science-based target. So it really is becoming common practice. And now we're even seeing, like in the state of California, there's a regulation called SB 260 that will hopefully go to the Senate floor soon. It will require all large companies that are based in the U.S., if they want to do business in California, they're going to have to measure and disclose their greenhouse gas emissions on an annual basis and set a science-based target. And I mean, I think this has been an evolution over a long time, where companies had to ramp up this practice of measuring their emissions on an annual basis, then start implementing reduction targets. Then it's evolved to science-based targets, all in a voluntary system. But now I think we're ready for a mandatory system. So I just see it as an evolution, but we got to get there really fast. Since the financial sector has taken a while to start moving, I think it's going to have to move even faster with the financial sector to move towards a more regulatory framework.
Okay. And can I ask you also to talk a little bit about, I guess I'd like to, when we're talking about kind of financial sector commitments, the main commitment being made is to reach net zero by 2050. We're seeing that all the time. BlackRock, JP Morgan, Citigroup, just a few big names to mention who've made such commitments recently. It seems to me that there's a difference of opinion in the market about what that really means. And it seems like having some kind of firmer definition on that would be useful for, I guess, for this conversation, for regulators, should they ever be imposing anything, and just for investors, shareholders, and so on, trying to take account of what banks and companies are doing. What do you think, given your sort of science-based targets work, net zero really means or looks like for a bank or a big asset manager?
Yeah. So, we've been doing a lot of work to think through what a standard looks like for validating companies' net zero targets. And we have defined this end state of net zero as abating emissions in line with 1.5 degree trajectory. And then when you get to this state of residual emissions, so emissions that can't be abated, then you're neutralizing those or balancing those with permanent removals. And I think there's a lot of traction that that's a credible definition for a company, but I don't think that works for a financial institution. And so a number of financial institutions have been setting these net zero targets, which is great. And I think they should all be doing this, but there needs to be work done right away on creating some standardized definition of what this end state of net zero looks like for a financial institution. And there's different thinking out there. Science-Based Targets is now going to be developing a paper to try to define what net zero means for a portfolio. I know the Race to Zero is doing a similar piece of work, and hopefully we can all converge around a common definition very soon, because otherwise I think it becomes an excuse for financial actors not to take action and not to set these targets unless they really know what it means. It's hard to commit to something. So I think we need to all converge on a common definition soon, so that there's no excuse not to set these targets.
Could that be a key achievement for COP, do you think? To have
and that's our hope. We're going to come out with a draft version of our paper at COP for public consultation. So hopefully we'll start converging around a common definition, but I don't think we'll have full agreement at that point from all the key stakeholders. But over the next year, I hope we'll get there. But also it's critical that financial institutions don't just set these long-term targets. They have to set these interim milestones. And that's where I hope we'll see science-based targets as becoming more commonplace for financial institutions.
Okay. With our time dwindling, Eric, maybe I could ask you, what are your hopes or your wish list, if that's the appropriate terminology, for COP? Like, what do you think would be a good outcome for climate finance at the COP?
I mean, continuing on with the theme about this is about everybody and everything they do. I think, a number of years ago, Aviva actually commissioned a very important piece of work which looked at value at risk and differentiated the value at risk to society of climate change versus individual commercial actors, and showed we had a big problem that, with business cycles so short term, it was hard to be motivated to make the decisions when climate change was a ways off. And we had Mark Carney with his Tragedy of Horizon speech at Lloyd's in 2015. I think the important message is that is no longer an issue so much, because the time frame has come into the business cycle. Now 2030, you're getting serious policy commitments. You're getting internal combustion engines, which are being phased out. So many changes are happening that business people can no longer say this is something for the future, which is for society's good, but doesn't affect my business. Really, it affects everyone. And I think for the COP, we need to come out with this broader understanding that not doing something, unless you're looking at your entire business and how it needs to be reworked, we will not be successful going forward.
Steve, with 30 seconds remaining, maybe I could ask you the same question.
I've talked a lot about harnessing the profit motive and making sure it delivers the Paris Agreement. I think partly to do that, we now need to harness the entire international financial architecture. It was all built post the Second World War, mainly to deal with world peace, not the climate crisis. We need to repurpose the entire international financial architecture. That means World Bank, IFC, IMF, and particularly the OECD, which is a $400 million organization of 2,500 economists who could really help right now. They need to manage this transition collectively for everybody.
Mm-hmm. Thank you. Well, time does not suffice, perhaps for the climate crisis, but certainly for this talk. Hopefully time will suffice for the climate crisis. Thank you all so much for making time to be with us. I'm going to pass over now to my colleague, Shaheen Contractor, a research analyst with Bloomberg Intelligence, and she's going to be looking at some of the trends coming up in ESG. Thank you all very much.
Thank you, Alistair, and thank you to everyone for joining. My name is Shaheen Contractor, and I cover ESG for Bloomberg Intelligence, which is Bloomberg's research team. So today I'm going to touch upon the growth that we've seen in ESG and also outline 3 trends that we think are going to shape the market going forward. So let's dig straight in. Now, we've all heard about ESG growing, but let's put some numbers to it. So if we look at ETFs, a slice of the pie, we see that assets have crossed 270 billion this quarter, which is about 5 times that of 2017. So growth that looks fairly exponential. Now, coming to the first trend, we've looked at asset growth, but let's take a look at where this money is flowing. On the slide, we have our Esg Etf Flow Charter, which tracks inflows and outflows into various sustainability strategies. Now, since this represents money flowing in and out of various strategies, I think it paints a good picture of market demand. What we see here is that while ESG is growing, the real growth over the last few years has really come from climate strategies. So things like clean energy ETFs or even low carbon ETFs, these are the ones that in 2020 saw growth of about 13 times and 7 times versus that of 2019. So numbers that are in no way small. And it's not just climate that remains at the heart of investor strategies. It also remains at the heart of corporate strategies. In fact, over the last year, we are seeing an increasing number of companies set carbon neutral goals. Now, what we see is that our BI carbon neutral theme basket, which seeks to track these companies, it grew by about 137 companies in 2020, despite the pandemic. Now, the second trend I want to highlight is the increasing scrutiny we think ESG funds are going to face to ensure that an ESG fund, in fact, is following its intended strategy. Now, in the US, for example, the SEC recently issued a risk alert for ESG funds, questioning their ability to follow an ESG theme. Now, this is becoming increasingly important as more and more funds come into the market and the strategies continue to grow. And not only that, they continue to diverge. So one of the ways to do this is to analyze the ESG performance for fund holdings. And that's exactly what we did in our Esg Etf scorecard. What this does is it reflects the extent to which a fund integrates ESG on a score of 1 to 10, with 10 being better. And hence it really helps to understand the ESG exposures offered by funds versus the regional benchmark versus peers, so that one can really look under the hood, really understand the ESG exposures that a fund seeks to offer. And the last trend I'll touch upon is the growth that we've seen in sustainable debt. So on the slide, we see that ESG debt, so green, social, and sustainability bonds, they've crossed 500 billion in 2020. And in fact, we think that if this pace is maintained, it could cross $1 trillion this year. One thing that I'll draw your attention to are social bonds. Now, as a result of the pandemic and racial equity issues, social bonds have been taking a larger and larger piece of the pie. And we think this is gaining in importance to creditors particularly. So it's really the emergence of the S within ESG. And with that, I'll end my presentation. But just to summarize, climate remains at the heart of investor and company strategies. As a result of the pandemic, we are seeing an emergence of the S in ESG, a clear sign of this being in the fixed income markets. Thank you everyone for joining, and I'll hand it over to my colleague Sanjay Rao to talk more about ESG's role in fixed income. Thank you, and enjoy the rest of the event.
Thank you so much, Shaheen, for that interesting presentation. And yes, I'm delighted to introduce our next panel of speakers for this very topical conversation. Joining us today, we have Stephanie Meyer, Global Head of Sustainable and Impact Investing at GAM Investments. Next, we have Matthew Guiganard, Global Head of Product Development and Capital Markets at Amundi ETF Indexing and Smart Beta. And also joining us today, we have Dr. Andreas Heppner, Professor of Operational Risk, Banking and Finance at University College Dublin, who's also a member of the EU Commission's Platform on Sustainable Investing. Thank you all for joining us today. Let's start by talking about the difference between ESG and fixed income and equity. So 4 or 5 years ago, when I was doing events in person rather than these virtual events, we do ESG panels with hundreds of attendees across asset owners, asset managers, and consultants. And effectively, we'd spend the first 5 minutes discussing what fixed income was. Effectively, there was a huge investment community built around ESG investing, but seemingly no contact with fixed income. Stephanie, why do you think that fixed income was so far behind the curve in incorporating ESG?
Well, I think it is certainly fair to say that listed equity has historically dominated both the products available and our overarching approach to responsible investment. But I think what we're also seeing is that, with fixed income, there's some real innovation around, green, social, and sustainability bonds as a sort of a new asset class as well. Perhaps just taking that a bit further, I think, in terms of how we integrate ESG issues, it's worth noting that, for fixed income, it is mainly looking at the downside risk and how we identify and manage that, whereas for equities, it's very much a sort of upside and downside balance that we're looking for. And ESG data, the availability of that data has been quite a limitation historically to enabling us to do that appropriately. I think, certainly most data that's been reported has been focused on listed companies and larger listed companies, and that's been reflected in the ESG data provision from standard providers, which left a significant proportion of the private market, essentially with limited ESG information. Now, I think that gap is closing through things like the credit rating agencies definitely incorporating those factors into the way that they look at ratings, in part driven by regulation as well. And we're seeing ESG data providers responding to that investor demand to enhance that data provision. But essentially, the integration, screening, thematic, and engagement approaches to responsible investment remain just as valid for the fixed income asset class as well.
Thank you. And Matthew, you cover both equity and fixed income products. Did you see a difference between the adoption across the asset classes, and why do you think that was?
Yes, definitely the early adoption was more on the equity side than on the fixed income side. And I think there are two structural or historical reasons for that. The first one is that when you look at the ETF market, fixed income is only a limited proportion of that market, around 20% of that market. So the big chunk of the assets is on the equity part. And historically also, regarding ESG, the engagement policy was very linked to the voting policy. And therefore, voting is linked to equity rather than to bonds. So that was the starting point. But however, we are really seeing a very quick catch-up in the fixed income assets. Since the beginning of the year, for example, if you look at flows in the ETF market, over 150% of the flows are going into ESG fixed income products. So showing that not only there is this very strong catch-up, but there is also a clear switch from vanilla to ESG products that is currently occurring in the fixed income asset class.
Great, thank you. Actually, Andreas, from the regulatory perspective, a lot of what we've seen relates to equity or corporate ESG, not so much on sovereign or securitized. Why is that? Do you have any view on that?
Well, that is the high-level expert group focusing on corporates. So that's essentially decided prior to the technical expert group and the platform. I think historically, the reason that fixed income is behind is not only ESG, fixed income is generally behind. So fixed income data is much harder to actually maintain. Fixed income itself doesn't necessarily have data availability for various issuers that are non-standard. So there could be corporates that are not listed in equity markets. There could also be IGOs and so forth. So it's a more diverse set of issuers. It's harder to actually develop the data. And then on the other side, equities are both easier to understand. We have existing asset pricing models. So academics work 95% on equity and 5% on fixed income. So that also means that textbooks very much are in that direction. And people love the narratives of the upside. Although most individual ESG KPIs are probably more related to the downside than the upside, marketing departments really love to spin the upside story rather than to talk about protection. And so in that sense, with ESG having historically been not too far away from marketing departments, I think that's the reason why it first developed on the equity side. But now, and Stephanie's title very much points to that, now impact is becoming a lot more important. And you simply have a lot more impact in primary markets and in secondary markets. So equity markets don't really have that much IPOs or SEO.
Great, yes. And actually, to reiterate those points from the index perspective, launching the fixed income indices, there's a range of differences that we needed to accommodate. As you mentioned, if you look at MSCI ACWI, that's 3,000 stocks versus the Bloomberg Multiverse, that's 30,000. And then 70% of our universe is non-public companies, either sovereigns, agencies, or securitized debt, which don't disclose the required information, or the information isn't relevant to their asset class. So it's very interesting to see that perspective. So actually, one of the other things we've noticed is when you talk to investors about using ESG, it means a lot of different things to different people. And most discussions I've had start with 10 minutes defining what the terms are. Given the lack of consensus, how have you seen fixed income products structured? And has this changed over the time in fixed income? Matthew, starting you work at the coalface of product development at Amundi. How have you seen the market develop?
Well, I think it started from very generic indices, looking at a traditional broad universe with the wish to apply an ESG approach to this kind of universe. And therefore, it started with the generic methodologies, applying sector exclusions and usually a best-in-class selection of the bonds. And from that very start, it moved more to thematic approaches, either with the climate approach that is being more and more popular, or with very specific themes around environment, social or governance that are also becoming more and more popular. I think those different approaches meet different demands. For investors wishing to stay pretty close to that traditional benchmark, they would use the more generic and holistic approach to their investments, keeping the same broad universe, but applying an ESG approach to that universe. And other investors are also now focusing more and more on the themes as those themes can bring either diversification in the portfolios or also sometimes a very clear alpha theme with some themes that are now becoming popular, so popular that the flows into those themes can also bring quite a lot of alpha to the portfolios.
Interesting. Stephanie, I think we mentioned differences in fixed income versus equity. How do you see the incorporation of ESG in asset classes not covered by equity? So sovereigns and new fixed income specific markets like green, social and sustainability bonds.
Great. Yeah. So I think in terms of, sovereigns, again, we have that data issue. Governance issues have, political instability have traditionally been, more commonly integrated into how we might assess sovereigns, but increasingly looking at what that, the relevant environmental and social factors are as well. One of the interesting elements, I think, within sovereigns is that, while often those ESG ratings are correlated with sort of credit risk, there's also a correlation with GDP. So there's a real question around whether by allocating to those better ESG scores, we're actually allocating towards essentially higher GDP countries, and is that where is that the intended outcome of the product? Certainly in our sovereign strategy, we do look at a sort of tilted approach in terms of looking at those companies that perform well on ESG factors, but look, I think, in a much more granular way in terms of how we integrate in particular the governance issues. I think green bonds and the slightly newer social and sustainability bonds, in both the corporate and sovereign space, are really attractive because of that use of proceeds, function. And I think if we look at those financing needs to meet the Sustainable Development Goals, then absolutely there's a really key and an increasing role for this asset class. And I think we've definitely seen that in terms of the increase in market size. Last year we saw the green bond market almost double. We saw in terms of issuance, we saw social bonds in particular. I think in response to COVID significantly increase. But one of the areas that I think is also interesting within the green bond space is those financial issuers as well. We've seen a lot of commitments from banks around the net zero, the banking alliance, and commitments to help finance the transition for those clients. And so I think the financial issuers and how they can use the green bond to allocate some of that the money to perhaps the smaller and medium-sized private firms, I think is a really interesting piece going forward.
Interesting. Andreas, any thoughts on how the fixed income market's going to develop in line with the equity, or do you think it'll differ?
I think it will differ quite a bit. So I think equity really is about voting engagement and sustainability and responsibility, expressing your views. But in many cases, except for clear-cut things like coal and tobacco and cluster munitions, maybe not directly about divestment on the fixed income side, it's predominantly primary market. So it's a lot more about the actual impact. So debt denial, I think, is a lot more of an attractive option than divestment comparatively. Lothian Pension Fund already, for instance, has put out the credo, deny debt and engage your equity. So react specifically on what has the bigger impact on this specific asset class. On the fixed income side, you also have essentially, just looking at the corporates, you have two markets, the one via the banks and the one that is going directly to the issuers. So any type of bank loan, if you're trying to, as an investor, impact companies that don't go to the bond market, that would go via the banks. Banks' Scope 3 emissions will get hugely important for that. And they do include the Scope 3 emissions of the loan book itself. So in addition, the sovereigns, as Stephanie just mentioned, they will get quite important. Sovereign Sdg bonds, not yet really happening, but conceptually, I think very attractive for investors because in essence, you get the guarantee that either a sovereign will be paying a classic Sdg bond type penalty, or they will be sticking to a certain SDG ambition, regardless of who is in power in that particular sovereign.
Thank you. So maybe we can pivot to the role of regulation in development of markets. I think with the EU Sustainable Finance Platform pillars complete now, we've also seen recent implementation of the French ESG labelling requirements and Belgium's Scrabble Fin requirements. How do you think this is going to impact the market? Do you think the range of regulation will help standardize the market, or do you think and help it grow, or do you think that it's at risk of potentially fragmenting it? Andreas, you've obviously worked closely on multiple parts of the EU regs. How do you see the synergies between markets and regulation?
I believe that certain aspects of the EU action plan will have a massive impact on markets. And the two things that I actually think will have the most impact are not necessarily the ones that are most attractive to be discussed in the media. So practically speaking, we're already seeing a huge impact on you're in Article 9 and Article 8, or neither of them in terms of a fund. So in essence, SFDR has a huge impact with that quite simple one trick. There's self-classification on behalf of the asset manager in Article 9, Article 8, or neither. The other one is Paris-aligned benchmarks. Paris-aligned benchmarks very clearly focus on actual emission reductions, in particular in fixed income. It is really emission reductions, not intensities, which is in equities. And as you may have seen just now on the Financial Times list, for instance, of the least or the best reductions of emission intensities, there's a lot of outcry on the LinkedIn and other platforms that is greenwashing and not necessarily actual performance. So we need to see from a Paris Agreement perspective that companies are reducing the absolute emissions. Paris-aligned benchmarks do that very well on the fixed income side. They have been heavily adopted. We have 25 billion plus, to my knowledge, in terms of assets under management, and we are not even 6 months post the effective date of this legislation. So it is the small technical things that I believe will change things immediately. And it's particular Paris-aligned benchmarks, to an extent climate transition benchmarks, and the SFDR classification by article that I think will make an immediate difference. Obviously, taxonomy will gradually make a difference, but as you may have seen, taxonomy is a significant political fight. It's not necessarily as science-based as it could be. And so in that sense, I think that impact will, at this stage, look somewhat delayed.
Interesting. Matthew, from the product development perspective, how have you found the different regulatory requirements and how they impacted creation and marketing of products?
Definitely, the EU initiative was very positive to us because originally this started by local initiatives with local regulations, be it for institutional like pension schemes, with very different regulatory requirements from one country, even sometimes one scheme to another. So there was really a very strong divergence linked to all those local initiatives and the local labels as well. So EU has really defined a pan-European standard with a common ground to build and to have all those initiatives converge into one single direction. So for us, this was very positive because it really enabled us to stick to those standards, to define the offer, and to see the demand converging towards those standards and matching the offer. So at some point, we could even fear that the UCITS approach, UCITS label, that was very positive to the European asset management industry, was really threatened by all those local initiatives. And again, with SFDR classification, with PAB and CTB benchmarks, with taxonomy coming soon, we saw those local initiatives gradually aligning to this EU regulation, and there is still more to come. But that was definitely a very, very positive move to support the growth of the ESG market.
So, Stephanie, do you agree? Do you see that the new regulations are bringing everyone in the same direction?
I think the regulations are certainly going to have a massive impact and already having an impact on the market. And I think in part it's actually the sort of comprehensiveness of the set of regulatory and policy measures set out by the action plan. Andreas has mentioned a number of them. I guess I'd also mention the non-financial reporting directive. I mean, one of the intentions there is to ensure that we have the data reported by entities. Also, the scope extends to public interest entities as well, to enable us to deliver on the disclosure requirements under SFDR. So the set of principal adverse indicators, and also on the taxonomy as well. So I think it's really important to look at the sort of corporate disclosure regulation alongside the specifically financial piece. And then, again, going back to green bonds, the EU green bond standard that's been proposed obviously very closely mirrors the ICMA sort of principles. But I think, where we've seen that sort of ratcheting is really on the requirements to, I suppose, align with that taxonomy for EU, but be much more rigorous on the reporting of use of proceeds and the impact metrics, which are going to become increasingly important to investors. And one of the big things that we'll look out for is really the extent to which these European-driven regulations are going to influence what we see globally, and we're already seeing that in Asia, looking at their own taxonomies, what the sustainable finance strategies will be there as well. So I think it's really important to look at this not just from a European lens, but also from a global lens.
Okay, thanks very much. So maybe now we take some questions from the audience. We actually have two on Paris-aligned funds, so that's in line with what we've been discussing. The first one, do you envisage many flows going to Paris-aligned funds? I think Matthew from the product development side, what do you see?
Well, definitely, we see that with the SFDR classification, Paris-aligned funds fall into the Article 9 category, which I would say now start to appear as the most demanding category compared to Article 8. And therefore, that gives an extra attractivity to those benchmarks. We have recently launched our first fixed income Paris-aligned benchmark ETF. So we see really traction growing on that part.
Great. Actually, the second question is, do you foresee any issues with being able to have a broad portfolio which is aligned to the Paris Agreement? Andreas, you worked intensely with the Paris-aligned regulations. So, the activity exclusions, they have a significant impact on the energy and utility sectors. Why remove rather than reduce them?
So, of course, we have two versions, right? So in the Paris-aligned benchmarks, they're immediately out, which is a much cleaner alignment with the Paris Agreement. In the climate transition benchmarks, you can have them. You just have to reduce them essentially year by year, or have to reduce someone else. So we do allow people to have that flexibility. Looking at AP2, for instance, and I discussed their alignment of the entire liquid assets, it's not really a problem at all to actually take them out. And if you really want to have an impact, then you have to make sure that there is no further digging and drilling. Pretty much exactly what the IEA said earlier this week, that any further capex into brown assets, coal, oil, and gas is not really aligned with the Paris Agreement, and not to say very problematic. So that the Paris-aligned benchmarks are very much actually, if you want, so front-running that particular IEA report, not even having known it. In the same way, the UN emissions gap report also focuses on 7% reductions, and it's also clear there that fossil fuels, so the cause of climate change, have to phase out pretty early. So people have the choice, but the cleaner alignment is to drop the actual fossil fuels straight away, which in fixed income means that you're protecting yourself from inadvertently financing brown capex, which I think many investors don't necessarily intend to do. But if people like, for instance, the big group of the Paris-aligned investor initiative of the IIGCC and Sirius and so forth, where some of the investors had concerns about the debt denial, if they prefer to use the climate transition benchmark approach, then they can very much do that as they outline in their report. So both options are there. One with debt denial, one without. So the Paris-aligned benchmark with, the climate transition benchmark without. Both will eventually arrive at the 1.5 degree scenario if executed appropriately. But it is safer to deny the debt to fossil fuels straight away.
Okay, great. There's actually one other question. How can we standardize transformational ESG faster so that the vanilla product investor can be part of our market solution versus disregard ESG? Stephanie, I see that as a question as to, do you need one ESG product that everyone understands, or can you have a range of products before and still have the market grow? How do you see the development?
Well, I think it's very important to have a range of products because we're trying to do different things from an investment perspective and also from an impact perspective. But I think what's interesting is a lot of the regulation is actually forcing and rightly sort of ratcheting up that expectation of the degree to which ESG issues are and sustainability risks are factored into investment decision making across the board. So in essence, we would hope to see more of the market transition because there's then less of a distinction between and we see the ratcheting of the distinction between what core looks like, where those issues are taken into account at a minimum level, and then some of the much more interesting products that we've been talking about today, the Article 8, Article 9, whether that's looking at the climate transition, Paris aligned, or the green, sustainable and social bond market as well.
Unfortunately, that's all we've got time for now. Thank you all for joining me today. Such a pleasure to get great insights from all my panelists. I hope our audience have found it as insightful as I have, and I look forward to seeing where we are next year, after what looks like another year of exponential growth in fixed income ESG. And we're going to have to leave it there. We're out of time. Thank you to all our speakers for joining us today. We're grateful for your participation and perspective. And to our audience, both within and beyond the Bloomberg community, thanks for joining us. Follow the conversation at Bloomberg Live on LinkedIn, Twitter, or like us on Facebook. And to learn more about other upcoming events, visit our website at bloomberglive.com. And thank you to our sponsor, Amundi, and everyone who joined us today. Don't forget you can watch this on demand, and please, thank you and stay well.